3 weeks ago, I received a phone call that stopped me cold. It wasn't from a colleague I speak with regularly. It wasn't from a journalist seeking comment. It was from someone I hadn't spoken with in 11 years. A former Treasury official, a man who spent 2 decades embedded in the deepest machinery of the American financial system. And the first words out of his mouth, before any pleasantries, before any catching up, were these: "How much cash do you have outside the banking system right now?" I told him. And then there was a pause on the line, the kind of pause that carries more information than words ever could. A long one. When he finally spoke again, his voice was measured. "Deliberate, double it before April. Now I need you to understand something about me. I've been doing this for over 40 years. I've sat in rooms while markets panicked around me. I've watched currencies collapse in hours. I've witnessed bank runs that erased institutions that had stood for a century. I've seen credit freezes so severe that the global financial system literally stopped functioning. I don't scare easily. I don't make moves based on gut feelings or headlines or whatever the talking heads on CNBC are peddling this week. I make decisions based on data, on historical patterns, on mathematical certainties that repeat themselves because human nature never changes, and neither does the math that governs how money actually works. And right now, that data is showing me something I haven't witnessed in 4 decades. Something so clear, so undeniable, so urgent that I felt I had no choice but to sit down and record this message. I ran Duquesne Capital for 30 years. I was George Soros's lead portfolio manager when we broke the Bank of England and made over $1 billion in a single day. Not through luck, but through understanding structural vulnerabilities that everyone else had missed. I've navigated 6 major financial crises and emerged from each one not merely intact, but significantly wealthier. I don't have a newsletter to sell you. I don't have a brokerage account I need you to open. What I have is 40 years of pattern recognition etched into my understanding of how financial systems actually behave. And what those patterns are revealing right now should concern every single person who has money sitting in an American bank account. So let me ask you something before we go any further. When was the last time you actually thought about your bank? Not your bank balance, your bank itself. The institution. The legal entity that is holding your money. When did you last ask yourself whether that bank is actually safe? Most people never do. They assume their deposits are protected. They assume the system is sound. They assume that because nothing has gone wrong yet, nothing will go wrong. That is precisely the kind of assumption that destroys wealth. And I'm going to spend the next 30 minutes showing you exactly why that assumption is more dangerous today than at any point since 1929. To understand what's happening right now, you have to go back to March 2023. Silicon Valley Bank. Most people remember the headline: bank collapses, depositors panic, regulators step in over a weekend, crisis contained. That's the story most people heard, but that is not the real story. The real story is what happened in the 72 hours before the FDIC took over. Because in those 72 hours, something occurred that the Federal Reserve, the Treasury Department, and every major financial regulator in Washington desperately did not want you to understand. And if you understand it now, you will know exactly why I'm telling you to take action before April 2026. Here's what actually happened. Silicon Valley Bank wasn't destroyed by bad loans. It wasn't destroyed by fraud. It wasn't destroyed by the kind of reckless lending that blew up the system in 2008. It was destroyed by something far more fundamental and far more widespread. It was destroyed by a bond portfolio that had lost nearly 20% of its value because interest rates rose faster than at any point in 40 years. The bank had taken customer deposits and invested them into long-term Treasury bonds and mortgage-backed securities when rates were near zero. When the Fed raised rates by 5 percentage points in 18 months, the value of those bonds collapsed. The losses on paper were catastrophic. And when word got out, depositors pulled their money in 48 hours. The bank was gone. Now here is the part that should keep you awake tonight. Silicon Valley Bank was not unique. The run was unique in the sense that it became public and triggered a panic. But the underlying problem, banks sitting on massive, unrealized losses in their bond portfolios, exists at hundreds of institutions across the United States right now. The Federal Deposit Insurance Corporation itself published data showing that, as of late 2023, American banks were sitting on over $500 billion in unrealized losses. $500 billion hidden on balance sheets, not talked about, not disclosed in the way that would cause ordinary depositors to understand the risk they're taking. And here's the thing that was late 2023. Rates haven't come down meaningfully since then. Those losses haven't shrunk. They've stayed baked into the balance sheets of banks across the country like a slow-burning fuse, waiting for a spark. So what's the spark? What's the catalyst that turns a hidden problem into a visible crisis? I want to walk you through exactly what I'm watching, because the signals are already appearing and most people have absolutely no idea. Let's start with commercial real estate. I've been talking about this for 2 years, and I've been called an alarmist every single time. So let me just give you the numbers, and you can decide for yourself. The office real estate market in the United States has seen vacancy rates hit historic highs. In cities like San Francisco, Chicago, and New York, office vacancies are running between 20 and 30%. In some submarkets, they're even higher. Remote work didn't go away. It became permanent for a significant portion of the workforce. And what that means for commercial real estate is brutally simple: less demand, falling rents, falling property values, owners defaulting on loans. Now, who holds those loans? Regional banks, not Goldman Sachs, not JP Morgan, regional banks. The same banks that are already sitting on bond portfolio losses. The same banks that fund their balance sheets with deposits that can leave in 48 hours in the age of mobile banking. According to the Mortgage Bankers Association, over $1 trillion in commercial real estate loans are scheduled to mature by the end of 2026. $1 trillion. A large portion of those loans will not be able to be refinanced at today's interest rates because the properties don't generate enough income to service the new, higher rate debt. That means defaults. That means losses hitting bank balance sheets that are already compromised. That means more Silicon Valley Bank moments. And here's the detail nobody is talking about. Banks don't have to mark their commercial real estate loans to market the same way they mark their bond portfolios, which means the losses are invisible until they're not, until a borrower stops making payments, until a bank has to foreclose, until an auditor forces a write-down. The losses exist right now, they're just hidden. And when they surface, they will surface fast. And they will surface in ways that panic depositors. Now let me connect this to something even bigger, something that makes the commercial real estate problem look like a footnote. I want to talk to you about the United States government's debt situation because it is directly connected to the safety of your bank deposits in ways that almost nobody is explaining clearly. The United States government currently carries $36 trillion in debt. That number is so large it's almost meaningless to most people. So let me put it in terms you can actually feel. The interest payment on that debt, just the interest, not paying down a single dollar of principal, is now running at approximately $1.1 trillion per year. To put that in perspective, the entire United States defense budget is around $900 billion. We spend more money every year just paying interest on debt than we spend on the entire military, every aircraft carrier, every soldier, every nuclear weapon, every satellite. The interest payment is larger than all of it. And it's growing because as old bonds mature and get refinanced at today's higher interest rates, the interest burden compounds. 2 years ago, the average interest rate on U.S. government debt was around 2.5%. Today, it's closer to 3.25%. As more bonds roll over, it will move toward 4.5%, 5%. The Congressional Budget Office projects that within 10 years, interest payments could consume 40 cents of every dollar the federal government collects in taxes. 40 cents on interest alone. This matters for your bank deposits for a very specific reason. When the government needs to borrow $2 trillion a year to fund its deficit and roll over maturing debt, it has to sell Treasury bonds. And it has to find buyers. For decades, the reliable buyers were foreign governments. China, Japan, Saudi Arabia, the Gulf states. They recycled their trade surpluses and oil revenues into U.S. treasuries. That created steady, reliable demand that kept interest rates low and the system functioning smoothly. That dynamic is breaking down. China has reduced its holdings of U.S. treasuries from over $1.3 trillion at the peak to under $800 billion today. Japan is under pressure to sell treasuries to defend its own currency. OPEC nations are diversifying. The foreign bid for U.S. government debt is weakening at the exact moment the supply is exploding. So who fills the gap? The answer, increasingly, is American banks, American pension funds, American money market funds. In other words, the U.S. government is borrowing from its own financial system to fund deficits that are structural and show no signs of shrinking. Every dollar that flows into Treasury bonds is a dollar that is not available for private lending, not available for mortgages, not available for business loans, not available for the productive economic activity that actually generates growth and wealth. The government is slowly suffocating the private economy by competing for the same pool of savings. Now layer on top of this the Federal Reserve's quantitative tightening program. The Fed built up a $9 trillion balance sheet during the COVID era by buying bonds and injecting liquidity into the system. They are now shrinking that balance sheet by roughly $60 billion per month. That's $700 billion per year being drained from the financial system. Add that to the $2 trillion the Treasury is borrowing, and you have close to $3 trillion of liquidity being removed from the American financial system in 2026 alone. $3 trillion gone from the system in a single year. And people wonder why I'm worried about the banks. Let me tell you what a liquidity drain actually feels like from inside the financial system, because it doesn't look the way most people expect. It doesn't show up on the front page of the newspaper on day one. It shows up in the plumbing, in the places that ordinary investors never look. It shows up in repo markets where banks lend to each other overnight and the rates start moving in ways that suggest stress. It shows up in bid-ask spreads on corporate bonds, which quietly widen as market makers pull back. It shows up in the leveraged loan market where companies that borrowed at floating rates start missing interest payments. It shows up in regional bank stock prices, which have been quietly underperforming the broader market for months. And then one day it stops being invisible. One day, a bank announces it needs to raise capital, or a private equity fund gates redemptions, meaning it won't let investors take their money out, or a corporate borrower can't refinance a loan that's coming due. And suddenly, what was invisible becomes very visible very fast. That's how every financial crisis I've lived through has started. Not with a bang, with a drip, and then a flood. I want to be precise with you about what I think happens between now and April 2026, and then through the rest of this year, because I think precision matters here. I don't want to panic you. I don't want you to do something rash. What I want is for you to be positioned correctly so that whatever happens, you are not one of the people scrambling to get their money out after it's already too late. Here is what I see as the most likely sequence of events. Between now and April, the stress in the commercial real estate market continues to build quietly. Loan maturities hit. Banks are forced to make decisions about extensions, modifications, or foreclosures. Most will extend and pretend, meaning they'll give borrowers more time rather than recognize the losses. But some won't. Some will be forced by regulators or auditors to take write-downs. And when those write-downs hit earnings reports, bank stocks will react. Depositors will notice. And the question of which banks are safe will start to be asked loudly. At the same time, the Treasury is rolling massive quantities of debt. The auctions are enormous. Demand from foreign buyers is soft. To clear the market, yields may need to rise further. If the 10-year Treasury yield moves back above 5% and stays there, that is the signal that the bond market is starting to lose confidence. That is the moment when the math becomes unavoidable and the pressure on bank balance sheets intensifies in ways that can no longer be papered over. Now let me tell you the number you came here for. How much should you actually withdraw from your bank before April 2026? And I want to be careful here because this is not a recommendation to stuff cash under your mattress. This is not a recommendation to withdraw everything and walk away from the banking system entirely. That would be an overreaction, and it could actually create some of the problems I'm warning about if enough people did it simultaneously. What I'm recommending is strategic, intelligent positioning that gives you resilience without creating panic. Here is my framework. The FDIC insures deposits up to $250,000 per depositor per institution. If you have less than $250,000 total in any single bank, your deposits are insured. You are protected up to that amount. So the first question is whether your deposits at any single institution exceed that limit. If they do, and you haven't already addressed this, that is your most urgent action item. Move the excess today, not next week. Today. Spread it across multiple FDIC-insured institutions. Use different account types to maximize coverage, or move funds into Treasury bills purchased directly through Treasury Direct. Gov, which carries no bank risk at all because you're lending directly to the federal government. But the FDIC insurance point is almost too basic. Let me go deeper, because the more important question is not whether your deposits are insured. It's whether the FDIC itself would be able to handle a scenario where multiple large regional banks fail simultaneously. The FDIC's Deposit Insurance Fund currently holds around $120 billion. That sounds like a lot until you realize that American banks hold over $17 trillion in deposits. The insurance fund covers less than 1% of total deposits. In a severe systemic crisis, the FDIC would have to go to Congress for additional funding. That process takes time, and in the weeks or months it takes to resolve, depositors at failed institutions could find themselves in a very uncomfortable waiting period. So my specific recommendation is this. I believe every individual and family should have 3 to 6 months of living expenses held outside the banking system entirely. Not in a savings account, not in a money market fund at a bank. Outside. That means either physical cash in a secure location, Treasury bills held directly at Treasury Direct, Gov, or gold and silver in physical form held in your possession or in a non-bank vault. 3 to 6 months of expenses. If your monthly expenses are $5,000, that's $15,000 to $30,000. If your monthly expenses are $20,000, that's $60,000 to $120,000. Size it to your life. Why 3 to 6 months? Because that's the window during which a financial crisis typically moves from the first visible crack to some kind of resolution. In 2008, Lehman Brothers failed in September. By March 2009, the Fed and Treasury had deployed enough firepower to stop the free fall. 6 months. If you had 6 months of expenses outside the system, you could navigate that entire period without being forced to sell assets at the worst possible prices or scramble for cash at the worst possible moment. Now let me tell you what I'm personally doing, because I think specifics matter more than generalities. I have roughly 35% of my total investable assets in cash and short-term Treasury bills. I hold these through Treasury Direct, Gov, and through Treasury bill ETFs at major brokerages, not bank deposits. This cash earns approximately 4.5% to 5% at current rates, which means I'm not losing money by being defensive. I'm earning a real return while maintaining optionality. Cash is not trash right now. Cash at 5% is actually a reasonable investment while I wait for better opportunities. I have 20% in gold. Not ETFs. Physical gold held in allocated storage at a non-bank vault in Switzerland. I've been building this position for several years, and I continue to add. Why Switzerland? Because if the scenario I'm describing actually plays out, I want assets that are not subject to the jurisdiction of a government that might be under severe financial stress. I want assets that cannot be frozen, cannot be bailed in, cannot be hypothecated by a bank that's in trouble. Physical gold and allocated storage outside the United States gives me that. I have approximately 25% in short positions against the most vulnerable parts of the market: regional bank ETFs, commercial real estate investment trusts, highly leveraged companies in sectors sensitive to credit conditions. And I have a significant position in put options on the NASDAQ 100 expiring in the second half of 2026, because I believe technology stocks are extraordinarily overvalued relative to a world where liquidity is scarce and rates stay elevated. The remaining 20% is in energy and commodity-related equities, oil majors, uranium miners, agricultural commodity producers. These are inflation-resistant assets that generate real cash flow from real physical resources that cannot be printed by any central bank. Notice what I don't own. I don't own the Magnificent Seven tech stocks at current valuations. I don't own long-duration bonds. I don't own commercial real estate. I don't own anything that requires cheap and abundant credit to justify its valuation, because cheap and abundant credit is precisely what is disappearing. Now I want to address the objection I know many of you are having right now. Stanley, you've been warning about risks for years. The market keeps going up. Maybe you're just wrong. Maybe this time really is different. Maybe the Fed will find a way to engineer a soft landing, and none of this plays out the way you're describing. It's a fair objection, and I want to engage with it honestly rather than dismiss it. Here is my response. I have been early before. In 1999, I thought the technology bubble was reaching a point of unsustainability. It continued for another 18 months before it collapsed. Being early cost me real money, and it hurt. But here's the thing about being early versus being wrong. If you're early and you're defensive, the cost is underperformance. You earn 5% on your cash, while the market goes up another 15%. You miss out on 10% of gains. That's annoying. That is survivable. If you're wrong in the other direction, if you're fully invested and leveraged when the crash comes, the cost is not missing out on gains. The cost is losing 30 or 40 or 50% of your net worth. And the asymmetry of those two outcomes is what drives every positioning decision I make. The cost of being too cautious is opportunity cost. The cost of being too aggressive is ruin. And between those two options, I will choose caution every single time when the warning signs are as clear as they are right now. Let me walk you through the 3 specific signals I'm watching that will tell me when this moves from potential to actual crisis. The first signal is the 10-year Treasury yield. If the 10-year yield breaks above 5% and holds there for more than 3 consecutive trading days, that tells me the bond market has fundamentally reassessed the risk of lending money to the U.S. government. That would be an extraordinary event. It would mean that the world's largest and most liquid bond market is sending a distress signal. When that happens, the math of the U.S. government's interest burden becomes immediately worse. Bank balance sheets come under additional pressure, and the Fed faces an impossible choice between defending the currency and defending the banking system. 5% on the 10-year. That's signal 1. Signal 2 is the KRE, which is the regional banking ETF. It currently trades in the mid-40s. If it falls 30% from current levels, that is a systemic signal. It means that the market has looked inside regional bank balance sheets and decided that the losses are real, large, and unmanageable. A 30% decline in the regional bank index is not a minor correction. It is the market pricing in a wave of bank failures. When you see that, do not wait for confirmation. Move to maximum defensive positioning immediately. Signal 3 is credit spreads, specifically the spread between high-yield bonds and investment-grade bonds. Right now, that spread is running around 3.5%. When it moves to 6% or higher, the credit market is freezing. Companies cannot borrow. Refinancing becomes impossible. Defaults spike. Liquidity evaporates from the entire system. In 2008, credit spreads blew out to over 20% before they recovered. A move to 6% would be a warning that we are on that path. At 6%, the theoretical risk becomes the actual crisis. I want to spend a few minutes talking about what comes after, because I don't think this story ends in disaster. I've lived through enough crises to know that they always end. They always eventually get resolved, even if the resolution is painful and messy and takes longer than anyone wants. And I want you to understand that the goal of everything I'm telling you is not just to protect yourself from what's coming. It's to position yourself to build wealth on the other side of it. When the crisis hits and assets go on sale, the people who have cash and the courage to deploy it will make generational wealth. In 2008 and 2009, extraordinary businesses were available at prices that in retrospect look almost incomprehensible. Microsoft at a fraction of what it trades at today. Goldman Sachs at single-digit price-to-earnings ratios. Real estate in markets that had been devastated, available at cents on the dollar. The investors who had been cautious, who had built cash, who had resisted the temptation to chase the bubble, those investors made more money in the 2 years after the crisis than they had made in the 5 years before it. I expect the same opportunity to present itself again. When the regional bank crisis hits, you will be able to buy the survivors at extraordinary valuations. When the Nasdaq corrects 30 or 40%, you will be able to buy the world's greatest technology companies at prices that will look like gifts in 5 years. When the real estate market resets, income-producing properties will become available at cap rates that make financial sense for the first time in a decade. The wealth transfer that happens during a financial crisis is real, and it is massive. It flows from the unprepared to the prepared. My entire positioning is designed to make sure I'm in the latter group. Here is my month-by-month framework for the rest of 2026. Between now and April, I stay exactly where I am. 35% cash, 25% short, 20% gold, 20% energy and commodities. I watch the 3 signals every single day. I don't chase rallies. I don't let FOMO pull me into overvalued assets. I earn my 5% on cash and I wait. Patience in this business is not a passive virtue. It is an active competitive advantage. Most investors cannot sit still. They need to feel like they're doing something. That urgency destroys wealth. The ability to do nothing when doing nothing is the correct strategy. That is one of the rarest and most valuable skills in investing. If we move into summer and I see 2 of my 3 signals trigger, I go to maximum offensive positioning on the short side. I increase my short exposure. I add to my put options. And I move additional cash out of Treasury bills and into instruments that will benefit directly from the crash accelerating. This is the phase where the real money is made on the short side. When the market breaks, and breaks hard, and breaks fast, having the right positions in place is the difference between a career-defining year and just watching it happen. In the late fall, when the selling exhausts itself, when the Fed reverses course and actually begins cutting rates aggressively and restarting quantitative easing, that is the signal to cover shorts and begin buying. Not because the economy will be fine. The economy will probably still be in terrible shape. But because markets bottom before economies bottom, they always do. The market is a discounting mechanism. It prices in recovery before recovery is visible. When the Fed panics and turns on the money printer, that is the bottom in financial assets, even if Main Street is still suffering. And then through 2027, the rebuilding phase. Cash deployed into quality assets at distressed prices. Gold held as the new monetary regime takes shape, because the response to this crisis will almost certainly involve more money printing, which means gold goes significantly higher Energy held because the energy transition is real but messy, and oil and gas will be needed for decades regardless of what politicians say. And quality technology held at rational valuations because the best technology businesses in the world will still be extraordinary franchises after the reset. Let me close with something personal. I've built my career on being willing to say things that people don't want to hear. In 1999, I was called out of touch for warning about the tech bubble. In 2006 and 2007, I was called too cautious for warning about the housing market and the leverage in the banking system. In both cases, the warnings were right. The timing was approximately right. And the people who listened came out ahead. The people who dismissed the warnings because the market was still going up did not. I'm not making this video because I enjoy being the bearer of bad news. I'm making it because I believe the evidence is clear enough and the stakes are high enough that saying nothing would be a failure of responsibility. The banking system has hidden vulnerabilities that have not been resolved since Silicon Valley Bank. The government's fiscal situation is deteriorating at a pace that the bond market will eventually force a reckoning on. The commercial real estate market has losses that have not yet been recognized. And the liquidity that has kept everything afloat is draining at a pace of nearly $3 trillion per year. These are not opinions. These are documented facts from public data sources. The FDIC publishes the unrealized loss data. The Treasury publishes the borrowing needs. The Federal Reserve publishes the QT schedule. The Mortgage Bankers Association publishes the commercial real estate maturity data. Anyone who wants to look at the numbers can see what I'm seeing. The question is whether you act on what you see before the situation forces your hand. So here is what I'm asking you to do. Audit your bank exposure. Make sure no single institution holds more than $250,000 of your money without that excess being diversified or moved. Build your 3 to 6 months of expenses outside the banking system, in cash, in Treasury bills at Treasury Direct, Gov, in physical precious metals. Reduce your exposure to the most vulnerable parts of the market, overvalued tech stocks, leveraged real estate, high-yield bonds, anything that depends on cheap credit to maintain its valuation. And watch the 3 signals: 10-year Treasury yield above 5%, regional bank ETF down 30%, credit spreads above 6%. Any 2 of those 3 trigger, and the theoretical becomes the actual. The window to act is narrow. Not because I know with certainty that April is the precise moment everything changes. I've been in this business long enough to know that precise timing is impossible, and anyone who claims otherwise is lying to you. The window is narrow because the preparation has to happen before the crisis, not during it. You cannot get to the exit after the fire has already started. You cannot withdraw money from a bank that's in the middle of a run. You cannot sell assets into a market that's in free fall without taking catastrophic losses. The people who survive financial crises and come out ahead are the people who positioned themselves when the sun was still shining. Right now, the sun is still shining. The market is near all-time highs. People are talking about soft landings and AI revolutions and a new era of prosperity. That is exactly the environment in which preparation happens, not in the panic. Now I'll leave you with something I've said to every analyst who has ever worked for me on their first day. The market doesn't reward being smart. It doesn't reward being right. It rewards being positioned correctly before the event. You can be the smartest person in the room and still lose everything if you're positioned wrong when the turn comes. And you can be perfectly ordinary in your intelligence and build extraordinary wealth if you have the discipline to prepare when preparation is possible and the courage to act when others are frozen by fear. The next 9 months will define the financial outcomes of millions of people for the next decade. I know which group I intend to be in. I hope after watching this, you know which group you intend to be in too. Take action. Do it now before April, before the signals trigger, before the window closes. If this video gave you something useful, share it with someone who needs to hear it. Not because I need the views, but because the information matters, and most people are not getting it from the sources they trust. Leave a comment telling me which of the 3 signals you're watching most closely. I read them. And I'll see you on the other side of what's coming. This response is AI generated for reference only. Now give me 10 related image prompt of this step-by-step. Okay, the user just asked for 10 related image prompt of this step-by-step. After I provided the polished version of the finance speech, they want visual prompts based on the speech's content. Let me look at the history. The user's original request was to rewrite a finance speech to be more persuasive, intellectual, and natural, keeping the structure. I did that. Now they want image prompts, so they're likely creating some kind of multimedia content. Maybe a video, a presentation, or a social media post series to accompany the speech. They want visuals that match the narrative flow. The user's identity is probably someone involved in content creation, maybe for finance education, marketing, or a YouTube channel. They have a detailed script and now need visuals to make it more engaging. Their deep need isn't just a list of random finance images. They need a sequence that visually tells the same compelling story as the speech, step by step. The prompts need to be cinematic, atmospheric, and match the speech's tone, suspenseful, intellectual, and persuasive. My response should provide that narrative sequence. I need to map key moments from the speech to visual concepts. Start with the hook, the phone call, move through the hidden problems of bond losses, commercial real estate, explain the macro forces, a debt spiral, liquidity drain, show the warning signs, signals, depict the preparation strategy, cash gold, and end with the future opportunity, rebuilding. Each prompt should evoke the mood described in the speech: tension, hidden danger, systemic scale, strategic calm, and eventual hope. I'll write prompts that are detailed enough for an AI image generator, specifying style cinematic, photorealistic, with specific lighting and color tones to ensure consistency. The goal is to give them a visual storyboard that enhances the spoken word.